What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hi there, welcome back to What's Making Headlines. It's Annie, Ben and Will here talking all things news and what we've been up to on The Advisor this week. Ben, how was your week?
Plenty going on and pretty busy, but I guess that's a good thing.
Yeah, you've been here holding down the fort because Will and I were at the New Broker Academy in Sydney on Thursday. I was over in Brisbane as well on Tuesday for New Broker, which was super fun. It was I think it's our 12th year of doing New Broker. I might have got that wrong, but we've definitely been doing it for a while now. And this year we were doing it in partnership with Bendigo Bank Broker. And it's been amazing to see how many people are coming to the event and wanting to become a broker, but also to see so many new brokers and meet them and see where they are in the journey. It was fantastic talking to so many new brokers who've been listening to this podcast, who've been reading the magazine and reading the news and getting to grips with all things broker world. Will, you were over there on Thursday recording some podcasts actually from New Broker. What do you think of the event? What was sort of the takeaways that you were hearing from brokers on the ground?
Yeah, it's great. A really good mix of kind of people that are kind of getting into it first year or 2 years and then more established brokers. I mean, it's great. Loads of good panels. Nice to hear from it was good. There was a panel actually. It was Aaron Christie David,
yeah, from Atelier Wealth, and Richard Brown from Mortgage Choice, and
yes,
Dom Vaughan from Aussie Liverpool.
Yeah, that was really good. Kind of hearing about. Obviously, you got the full range of starters and loads of experience, hearing about how they got into it and early challenges.
Yeah.
So yeah, really good event. Enjoyed it.
Yeah, and I think that actually that panel specifically, we're doing it in Melbourne on Tuesday as well, and hearing from brokers, local brokers, about where they are in their journey, as you said there. So like we have someone in their first year, someone who's a few years in, and then someone who's got like 10 plus years of experience. So seeing how much broking has changed is really interesting, but also then seeing, some of the similarities as well in what they're doing. So it was really cool to see them kind of bounce off each other about, well, how did you do this? And so many questions on the floor as well about, asking particularly some of the elite brokers saying, well, how did you get your leads in through the door? How did you get your referral partnerships set up? And we had sessions on those as well. So really great to see so much knowledge sharing and support in the room. I loved it. Absolutely loved it. Lots of questions as well at New Broker around the qualifications you need to become a broker, plus all the sort of regulation that's around it as well, including best interest duty, which was something that was talked about this week in the news. We've had some updates from ASIC, and this is something that we kind of knew had been going on for a while. So best interest duty came in 2021, and typically the financial services regulator ASIC will kind of review how a new law is being embedded a few years after implementation. So this is the first time we're actually seeing the best interest duty being, I guess, tested almost as kind of like an audit check, I suppose, of how best interest duty is kind of being applied in the broker space. So we knew this was going on. ASIC actually started undertaking a review of this a few years back, but then paused. I'm not entirely sure why, but then they picked it up again, and we've been hearing from some of the aggregators, off record at least, about what they've been being asked for and what sort of things they're seeing. But then we actually officially heard from ASIC earlier this week because Alan Kirkland, who's an ASIC commissioner, was speaking at an event on Tuesday at the Australian Finance Industry Association's event, which was some sort of risk summit in Surfers Paradise. And they released the speech following his delivery of it. And in it, he actually revealed that they were looking at gathering information on lending involving brokers. So this is something that ASIC's been sort of looking at basically as part of its sort of general enforcement priorities. It has different areas of lending that it sort of looks at and tests. This year, we know they were focusing on things like predatory lending, short-term credit contracts, car lending, but also apparently brokers. So I'm going to actually just read what Alan Kirkland was saying. He's actually the former Choice CEO from 2012 to 2023. He joined ASIC, I think either last year or the year before. But he said this. We continue to be interested in the conduct of brokers and are currently engaging with several large mortgage aggregators to gather data on patterns of lending involving brokers, which may inform further action by ASIC. Now, I reached out to ASIC to say, what exactly does this look like? What are you doing? What are you testing? And they kind of said, we don't have any further commentary at this time. We don't comment on sort of active investigations, I suppose. Well, it's not really an active investigation per se. It's what they're calling a data gathering exercise. So I think generally they sort of said we're not really looking at anything in particular yet. And I should note as well that the ASIC commissioner in his speech did note that there are super low complaints in the broker channel. He wasn't sort of suggesting that there were any big issues they were looking at, just sort of testing how bid compliance is going through. But yeah, he did say, we recognise the continued growth of the broker channel as well. And I was having a chat to Peter White, the managing director of the Finance Brokers Association of Australia, and he was saying when they've been talking to ASIC earlier this year, one of the things that was flagged was that because the broker channel is so dominant now, that's kind of one of the reasons they're looking at them, because they're like, well, if you're taking up 3/4 of all home loan borrowing business, then we kind of want to see how are you doing it, making sure that there's no building risk here. So I think that's quite interesting. It's almost like you become a victim of your own success, where you've become so big that because of the size of it, the regulator's keen to have a little look under the hood. But again, I should say the ASIC Commissioner did say, obviously there's a relatively low level of consumer complaints, but he did say, we are conscious that misconduct by brokers will not always be obvious to their customers, and our track record of regulatory action indicates that the sector is not immune from misconduct. Which I was a bit like, ooh,
That's a bit pointed.
spicy, yeah.
Yeah.
Real. And especially again, there's some of the figures that were raised in this speech. He'd said, we'd taken ASIC had taken regulatory action against a number of finance mortgage brokers, resulting in 11 companies being handed criminal sentences, 14 being banned from credit activities, and the cancellation of 22 credit licenses and 1 license suspension. But there's no detail about what those were. So I had a little look back to see if I could find them. And most of the ones that I found were either people who'd kind of stopped practicing, or were people who had left the industry because of these issues. So I'm kind of like, we already know about these. It makes it sound like there's heaps of things going on that are bad. And he also raised the Rams misconduct that we talked about, I think, last week in the podcast about, the alleged misconduct going on in home lending as part of the Westpac-owned Rams subsidiary issues. And again, as we said last week, they're not brokers. So yes, they might be credit reps under Westpac, but we wouldn't call them brokers. So very interesting to see what ASIC is looking at. And of course, this is something that's going to be carrying on over the next few months. I know a lot of aggregators will have quite a hard time, I think, trying to pull up the information that ASIC might be looking for, because as we know, a lot of the aggregators have a huge amount of data at their fingertips, but they don't necessarily always see what goes to the lender. So I think they're going to have a real challenge trying to pull together some of this information. I think the things that they're looking at include, how broker commissions, white label loans, recommendations that brokers give to clients, and how they're actually kind of meeting bid that way. So it'd be really fascinating to see. And I'm sure all the information as it comes through will be reported on by us as we get it, if we ever get it. And I would say as well, Annie Kane, the CEO of the Delay, also said that while the review was on hold for a bit, they always knew this was coming. So she was sort of saying, it's something we've always anticipated. We've been in discussions with ASIC for a long time. And again, looking at bid, sort of saying, we know it's well embedded across the industry, continues to deliver strong consumer outcomes. Look at the fact that we've got such low complaints, and just basically saying, yeah, we know this is happening. We're not too bothered about it, basically. But interesting. First testing of the new regulations, and at New Broker, actually, there's lots of conversation being like, how is best interest duty kind of applied, because it's so subjective. Obviously there's guidance out there from ASIC, but I think there's a lot of questions about what will this mean? Where do we go from here? We'll have to wait and see.
I guess it still is relatively new as a concept, I suppose. It's only 4 years old, really. So
yeah.
There is probably that piece of evolution that might come out of the ASIC review. Perhaps.
Yeah. And I think, they'll probably, inform any updates to guidance and see if there's any issues. But I guess when you have a new law, like it isn't until it's tested can you see how successful it's been, and it isn't until you actually go back and review it that you can see whether or not it's working. So I think it's obviously the first step in ASIC's process. But yeah, it sounds like the first step, and they expect to be doing something else after it. Especially some of that comment from Alan Kirkland saying, which may inform further action, which is what raised my eyebrows at least when I read it. We'll take a quick break here, but when we come back, we'll be talking a little bit more about what the regulators have been up to, and we'll be back in just a moment. So outside of the financial services regulator, we also heard from the prudential regulator this week for our news, and particularly, I think, looking around student debt. And this is something that we've been talking about for a while. Will, I think you covered this story for us on The Advisor. What's happening?
Yes, so this is APRA changes to student debt, and this follows, we covered it in, I think it was February, Treasurer Jim Chalmers basically said that the way banks treat student debt should be a bit more flexible. It shouldn't just be lumped in with other debt to help first home buyers get on the property ladder. And this kind of follows on, they've touched on it before, but now they've finalised regulations which will come into effect from 30th of September. And there's loads of kind of interesting stuff, but just going over a few of the headlines. They've essentially said that student debt should be excluded from the credit limit of all debts held by borrowers when looking at debt to income ratios. And obviously there's a little bit of a grey area, but APRA basically said that banks can take into account individual circumstances of borrowers, the nature of the debt, when assessing their borrowing capacity. And they also got feedback from banks. I think there was, off the top of my head, 8 banks, and broadly they said it was a good thing. There was a bit more flexibility. They did question how they should treat debt, if their student debt, if it wasn't just lumped in. And APRA basically said, I thought it was quite a good quote, they said, you need to make judgments in line with your lending policies, risk appetite, and after considering individual circumstances. So
It's not really an answer, is it?
no, it's basically saying case by case,
Yeah.
and you have to make the decision.
Yeah.
I think it's good that there's flexibility.
Yeah, you don't want it to be too prescriptive,
Exactly,
so you kind of
yeah.
need it to be within their own risk appetite. But I thought one of the things that was actually interesting about that as well was saying a bank can consider if it's reasonable to remove the student debt repayments from a serviceability assessment when a borrower is expected to pay off their debt within 12 months. So
Yeah.
this was something that I think was talked about when they did the initial kind of consultation with industry, being like,
Yeah.
what do you think? And this was something that people were like, well, given that serviceability is quite tight and you've got help debt, if you're going to actually be paying that off, it'd be great to not have that impact whether or not you can actually get a home loan that you're going to have for the next 30 years. So
Yeah.
particularly if you might be paying off in 6 months or something, it sort of feels like that's a big shadow weighing on people. But it's interesting because I think help debt is still debt. So it's sort of
Yeah.
a bit like, it's interesting that it's sort of been carved out separately from the rest of liabilities that borrowers hold. And some brokers that have been commenting on the story, I think, were saying, well, why are we having this ability for lenders to pick and choose what debt they're actually putting in serviceability? If they get the loan settles, but then they can't pay their loans out, like they still can't afford it. So it's sort of being like, where is the sort of common sense here? So I think it is very much going to be a case by case, like if lenders want to do it, they kind of can, but interesting to see. And I know that some of the lenders already have started doing this.
Combank do it already. A few questioned why it was 12 months. They said, why have we picked 12 months as a reasonable time frame? Which I think is a good point. I think it's just the standard. That's what APRA have deemed reasonable. But there's definitely grey area around. Even they said banks should just do it in line with their policies. But if one bank is more exposed to risk, then they're obviously going to kind of accept a higher level of risk. So it's a difficult one to regulate, but good that there's flexibility, but you do wonder if banks pushed it too far, if they could be exposing themselves to too much risk.
Yeah, and I think like what APRA was sort of saying was like, well, part of this is because help repayments are actually deducted from income. So it's not like you've got a choice on whether or not you pay it. It kind of just happens. So they're
Yeah.
saying, well, therefore it shouldn't really be something that we're kind of testing against when you're looking at serviceability, because there's nothing you can do about it. So I think that's fairly interesting too. But that's always something, again, seeing all these sort of tinkering around prudential regulation. We had a lot of commentary last year as well when they did that big review into serviceability buffers, and the year before that as well, looking at what else can be done to kind of ensure that people are able to enter the home loan market. But as always has been the argument, the problem is really not with prudential regulation, it's with the cost of housing. So it's sort of being like, well, sure, you can play around the edges, but you don't want to play around too much because you don't want to increase risk in the financial markets. You want to actually just address the fundamental problem, which is not that serviceability is necessarily the issue, is that the cost of housing is so expensive. It's very hard to get a mortgage that reflects current market prices. I think we're seeing now, the average house is over $1 million now in Australia. I think that data came out last week from Cotality, and especially here in Sydney, way above that. I think it's like 1.1, 1.2. So yeah, lots going on in prudential regulation. Not the only things we've been seeing though, also some crackdowns and fines coming out. We're all talking about really like compliance here. This is a lot of the conversation today. Ben, you were writing the story for us yesterday, which involved one of the major banks. What happened?
Yeah, so basically the ACCC has issued NAB with a record $751,200 in penalties after receiving 4 infringement notices regarding alleged breaches of a consumer data right, or CDR rules. So as part of the CDR, participating lenders have to sort of ensure that the data consumers have consented to be shared is sort of kept accurate, up-to-date, complete in the required format. However, the regulator has alleged that NAB failed to disclose or accurately disclose the credit limit data in response to 4 separate requests made by different CDR accredited providers on behalf of the consumers. So the impact of this on fintech services, it impacted several fintechs, including some that offer mortgage brokerage tools that are reliant on CDR data, which is why the ACCC issued the fines. The important thing to note is NAB was fully cooperative in the investigation and the infringement notices. We got a comment from Sujit Rana, who's NAB's chief digital officer, and he said they've cooperated with the full investigation, happy to pay the fine and sort of make sure.
We're not happy.
Maybe not happy to. Maybe not happy.
They will pay the fine. Yeah.
Pay the fine, but they sort of said we fully cooperated, and we appreciate and recognize the importance of ensuring we're meeting the standards necessary and expected under the regulations.
It's one of like several issues we've seen in open banking, and this has been part of the problem, I think, with open banking. Even though we love the idea of it and everyone wants to use it, is that it's just not accurate. Like a lot of the time we've got problems with, because it's not sort of standardized, I think is the main issue. There's still lots of things being applied to it. Some of the data is not accurate. Some of the data is just miscategorized. We know we've been talking a lot about open banking and some of the fintechs that operate in the space kind of saying I think there's a report from Stride, and they were saying that there was something like 70% of all requests had some issue. And they were like, well, this is ridiculous. Like, how are we meant to rely on this information if what's happening is kind of being manually input or is being input incorrectly because of an algorithm being wrong? You know, things like, I think we should also reference, which brokers will probably know really well, is the total loan amount net of offset, or is it total loan amount? Like, what is the actual volume that's you're looking at here? And when it comes to interest rates, like, is it the interest rate applied? Is it standard, or is there a discount? And all of that sort of thing is like, there's so much variance in it. So it hasn't got quite where we want it to be. But I think this is the first time we've seen a CDR fine, as far as I can recall, at least in the major bank space.
It's definitely the biggest one we've seen so far.
How much was it?
$751,200.
Wow.
Related to 4 different notices.
Yeah.
That's kind of what the ACCC's deputy chair, Katrina Lau, was sort of saying. She says when there is poor data quality, that kind of undermines the benefits of the whole scheme. So yeah, I think, as we've sort of seen, though, it's quite difficult to ensure the systems and processes are in place that ensure the data is correct and has that integrity.
Yeah, you want to be able to trust what you're seeing. So a big case there, and I'm sure we'll be seeing more updates and tweaks to the open banking and CDR regime as we go forward. We'll take a quick break here. When we come back, we'll be touching a bit more on trust as we unpack some of the findings of the big consumer access to mortgages report released by the FAA this week. And we'll get into that just after this. So, Will, you were writing a story for us, well, actually several stories on this big new report, Consumer Access to Mortgages report. We've seen it produced over the last few years. It's actually conducted by the FBAA using Agile Market Intelligence, which is part of the Momentum Group. So we were having a good old chat about that with the Agile team and sort of going through the data. What does the report tell us this year?
Yeah, so loads of interesting stuff in there. I'd say kind of headlines, a lot around trust. So in terms of, they looked at kind of people getting mortgages through brokers and the proprietary channel. And brokers, actually 82% of clients said they had trust in the mortgage broker. And that was compared to banks where 67% of clients said they had trust. So good news for brokers there. They also looked at customer satisfaction, actually fairly similar. Brokers were slightly ahead, 79% clients were satisfied versus 76 for banks. And then some really interesting stuff around best interest duty, which was quite surprising, I thought. So 28% of borrowers were more likely to use a broker after they'd learned about BID, which isn't that surprising. But just 51% had actually heard of BID. Yeah, which is crazy.
Yeah. And I think this is when it first came out again in 2021. A lot of what the broker channel was saying is like, obviously having additional compliance is never fun, but they were like, but actually it kind of stands us in good stead because we can say we are legally obliged to work in your best interest. The bank is not, or a lender is not. They obviously, most lenders can only offer the products available to them, so they can't necessarily guarantee that it's going to be in the best interest of the consumer. They might not have a solution for them, whereas brokers can access pretty much everyone if they want to, if their aggregator panel let them. But they can access a lot of lenders. So for them, it's a real like feather in the cap to be like, you can use us and be rest assured that we're going to act in your best interest. But the fact that half of people hadn't heard of it, maybe there's depending on what happens with the ASIC review at least, maybe there's a case for the broker channel to be championing it a bit louder.
Yeah, I think it's actually quite a big selling point that's probably brokers could be a bit stronger on. I remember the S&P report a couple of weeks ago, loads of people mentioned that in that it actually differentiates them from banks and that we're doing this and they're not. And actually we're legally obliged to act in your best interests. Yeah,
the S&P report, again, if anyone didn't catch that, was around the banks, particularly major banks, really leaning into their proprietary channels and saying, will they be taking away market share from brokers and using AI and tech to do that? And lots of the responsive brokers were saying, well, no, because we have BID. So haha. But yeah, I thought that was a really interesting report, and there's lots in there to unpack. I think we've got a couple more stories coming out about it as well with some of the findings. So again, if you do want to check that out, it's on The Advisor, of course, as is all of the news that we've been talking about so far today. Next week, we've got some big things coming up. We've got New Broker Academy on Thursday, actually. I think I said Tuesday earlier. It's actually on Thursday next week. We've also just launched our SME Bootcamp, which will be coming around in September. So if you do want to come along and find out a bit more about diversification, how to read business P&L balance sheets and cash flow statements and help small business clients get access to finance. This is open to pretty much everyone in the financial industry. You don't have to be a broker. You could be an accountant if you want to, because so much of this is around helping SME clients and really seeing brokers and accountants work together on it. So open to everyone. Come and check out SME Bootcamp in September. Or if you're in Melbourne next week, come along to New Broker, because New Broker is also free to attend event, thanks to our lovely partners, including Bendigo Bank Broker. There's also at the event professional headshots being done. It's quite fun seeing everyone pose for their headshots. I expect to see all their LinkedIn profiles changing now with the new headshots available there. So that was really fun. And yeah, hopefully we'll meet some more listeners of What's Making Headlines and readers of The Advisor at that event next week. Will, Ben, any nice plans for the weekend?
Not too much at the moment, but hopefully something sort of develops.
Yeah.
Seeing stand-up comedy tonight. Should be good fun.
Who are you seeing?
I have no idea. It's a comedy club. Should be good fun.
Yeah.
Yeah, you got much planned?
I've got dinner on Saturday. I don't know where it is, somewhere in Surrey Hills. And then, just sort of doing boring life admin.
Classic. Yeah.
Trying to save some money, Oh, goodness. But I hope everyone else has a great week. And do check out all of the other news on theadvisor.com.au and all the podcasts on the Advisor Podcast Network. And we'll catch you next time for another episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.